What's up, guys? Jonathan. So yesterday I put out a video talking about skew. It's really, really important for option traders to learn about skew. Even if you don't trade options, it's a really important video because skew can give you a lot of kind of color on what's going on with a given stock. I'm going to link to that video, upper right corner, hopefully. Today, I'm going to be talking about unusual options activity because along with skew, unusual options activity is something that all option traders should be aware of. And there's not anything else in options trading that people get wrong more than unusual options activity. And even CNBC is a great example that every single week they get it wrong 2 or 3 times when they say, hey, look at all that upside call buying in this name, it's bullish. Or look at all that downside put buying in a given name, it's bearish. I'll give you an example. I'll give you an easy cheat sheet on how to look at unusual option activity. In front of you, GCAP. GCAP's a stock I cover closely. If I go to a 5-minute, let's go to a 1 minute actually, so we can look at what's been going on today. Wednesday, start of the day right here. Now, volatile stock, right? Gets hit in the morning, 960 down to 9. Not much going on here, not much going on here. And then all of a sudden breaks out. Now, the trading rooms are going to say it coiled, and all of a sudden broke out. But come on. There's a reason why a stock moves like this. And the reason why the stock moved is not because it coiled, and it just got so tired that it needed to move. No. It was because there was a massive order that pretty much took out the entire book. They bought a ton of options, and then the market makers who sold them those options, the market makers are going to trade what's called delta neutral. Market makers don't want directional risk. Market makers really only trade volatility. So if somebody buys a whole bunch of calls, somebody sells it to them. In this case, the market makers sold it to them. So if I go over the options, so now I'm at the options. We look at GCAP, and I put up the options time and sales. Think or swim, you just kind of go to this little beaker. Boom. And you can see the biggest orders for the day. Wow-wee. Look at that order right at the close right now. That's a big order. So look here. 11:24, 11:26 Chicago time. Somebody comes in and buys 250 of the 9 strike calls, and they bought them for $1 and $1.10. Now, if you look at all this, you really can't tell definitively what that order was, because what institutions do is they might put a really big order through, but if they sell stock at the same time, they can be synthetically doing a put rather than a call. It's going to be a little bit more advanced than what this video is. But if I just look at the timestamp, 11:24, 11:25, 11:26. If I go back to the chart, and if I look at the timestamp, 11:24, 11:25, 11:26 is all this stuff right here. So what happened was they did 250. The market makers filled that order, so they sold the calls. So the market makers are going to be short stock, well, short delta. So they sold the calls. Now to hedge themselves, they have to buy stock. And that's why the stock goes from $9.10 all the way up to $10. Because those market makers had to hedge a whole bunch of stock. Once they're done hedging it, it went down, it went back up, continued with the ebb and flow of its normal move. But there's a reason of why these things move, guys. There's more to life than just technical analysis. Figure it out. Look at unusual options activity. It can give you some really great color on a given name.